Welcome to Subramani. I'm not sure how many of you have heard the word viatical, V-I-A-T-I-C-A-L, viatical or viaticals. I'll explain in a minute. Suppose you bought a regular endowment policy for say 30 years. You paid 1 lakh of rupees as premium for 6 years. So you paid 6 lakhs. And after 6-7 years, you go to the insurance company and say, I wish to surrender the policy, can I have my money back? So the least you expect is to get back 6 lakhs which you have paid, right? Wrong. The great life insurance corporation, which was the only company selling life insurance, had a black box by which they would compare the premium paid to the premium outstanding. So you took a 30-year policy, you paid only 6 out of 30, right? So that is only 20% of the premium paid. So based on some black box formula, they'll come and tell you, oh, we can pay you only 4.2 lakhs or 4.3 lakhs, right? At best. And you had no choice. You had to go back to LIC and say, please, can you do something? And they would say, sorry, we can't do anything. Typical monopoly behavior and typical regulator behavior. The regulator said, no, LIC, what LIC says is final. Cut to 2002, 2003, private insurance was allowed in. We had IRDA coming in. Did IRDA make any changes in that? No, nothing of that sort. The same old system continued. In fact, somebody from LIC would go and head IRDA. It was a very nice, cozy relationship where the only loser, as usual, is the person taking the life insurance policy. So now what has happened is, I have always held the view that in UK and US, there is a very aggressive viatical market. So you go to LIC and LIC say 4.3, you go to another NBFC, they may offer you 4.8, or another NBFC may offer you 4.9, right? So if there's a very good secondary market for viaticals, under the supervision of IRDA, let IRDA put in some of the rules and regulations saying what can be the minimum that you have to pay. Obviously the minimum is what the company would pay, what is the maximum you can pay, and ensure that the payment comes, right? Put in all these adequate safeguards and then come to that market. Would our regulator do that? No, the regulator would not do that. So recently I saw an article, so let me read from that. The IRDA is set to shake up the insurance landscape with its draft product regulations. Okay, so come to currently under the existing IRDA regulations for non-linked insurance, which is the classic endowment, surrender values are determined based on the percentage of premium paid by the policyholder, scaling with the number of premium paid. Exactly what I said. In a bold move to enhance benefits for policyholders, the regulator proposes a significant shift. According to the draft, surrender charges would be applicable only up to a defined threshold limit of the premium for each product. Beyond this, insurers cannot impose any surrender charges. The entire premium balance of premiums exceeding the threshold will have to be refunded to the customer. So then this article on Money Life by Sucheta Dalal says, consider a non-participating policy with an annual premium of 1 lakh for the first 3 policy years. Assuming a threshold limit of 25,000 per year, the surrender value percentage, that is 35% for third year surrender, will be applicable only up to 75,000, which is 3 years premium. Any premium beyond this threshold will be fully refunded to the customer. This is a very noble act, but it would have been much better to just open the viatical market and let the market decide how much the person would get on surrender. For example, if a person is doesn't have too many dependents but has a big policy and has cancer, right? So the doctors have told him you live another 2 years. He needs the money now. So he comes in desperation and says, look, I want this much money. The buyer of the viatical product or the insurance policy takes a bet based on his own actuarial calculation that this person won't live beyond 2-3 years. So based on that, he does a discounting and gives a very good price and holds the policy till this person dies. Sounds very cruel, but this is how the market works. If there is a financial product which somebody wants to buy, it will be funded by a bank if the bank is convinced that guy can repay. Here is a risk which an insurance company took 10 years ago of issuing a policy to a person. So that company would be very happy to buy back that plan at whatever price he wants, because the whole claim will not have to be paid. But the NBFC, if they receive this policy before they go to the insurance company, they would happily give a even higher price, saying, okay, we are taking a bet this man will live for 2-3 years. Ultimately, insurance is just an option, right? It's on your life that they have an option, and they have said, in case you die, we will pay so much. It is just an option on your life. Here the option on life has got more attractive because this person is likely to die earlier. Sounds very morbid, I know, but this is exactly how the insurance industry works. Now, if this person were to go to the insurance company and say, I want to surrender my policy, he'll get a price which may not be as good as it would be by an NBFC. An NBFC may give him a better price. So the best thing that the regulator should have done is open up the viatical market under the supervision of IRDA, and then see how it works, instead of tinkering with the law. But that is exactly how a regulator will operate. A regulator cannot think of a market-based solution. And I find the whole thing very funny, because if they open the viatical market, it will open up it will make the insurance companies far more efficient and far less criminal in their approach to saying there is no surrender value for a policy paid for 1 year or 2 years. Beyond the 3rd year, we will give you a particular amount only, right? So all those what I would think mischief by the insurance companies would have gone if just the viatical markets were opened up. But then regulators can't think like market operators. Market operators shouldn't think like regulators. That's how life operates, right? Thank you.